Hi, I'm Grant Stevens.
And I'm Kris Bernier.
And we're the two investment guys. This week, Kris and I are going to talk a little bit about some of the more important factors in markets. One, of course, is the U.S. economy, but also valuations, metrics around that. Kris, when we look at the U.S., really important economy globally, we've seen mixed markets of late, just in the last couple of weeks, say, after a good quarter. Now, when we talk about the U.S. economy, it's really important to understand a couple things. One is, obviously, it's the largest economy on the planet. It is 25% of the globe's economy as a whole, with 5% of the globe's population. So in terms of a productivity measurement, that's pretty impressive. The annual production in dollar amounts is $15.7 trillion, and if you compare that to Canada, we're at about $1.4 trillion, so it's of monster size, really. What we see is, markets, the general view is markets have really come a long ways, and they're close to all-time highs, and the economy matters, but is this the point in time to be getting into the markets? And my comment would be, really? They're at all-time highs? I think there's other ways of looking at that, and that's what we want to talk about here.
That's right, absolutely. So if we look at the S&P 500, we're talking about the 500 largest companies in the United States. We go back to the year 2000, that was when we had reached the tech bubble, markets were peaking then. The S&P 500 was priced in at about 1527. Today we're sitting at a roughly the same level, 1560, 1565. But there's a variety of different valuation metrics that we can look at to compare whether there's value today versus back in 2000. Back in 2000, if we look at the earnings per share per each unit of S&P 500 was $51. Today it's $102, so twice the amount of earnings. Another valuation metric we use, Grant, is price earnings multiple.
Yeah, so back then it traded 29 times what the earnings were, and today it's 15, so about half. When we look at dividend yields, Kris, back then they were roughly 1%, now they're 2% or twice as much. Yeah. And also, if we drill down on where was the 10-year Treasury in 2000, 6.2% versus today, 1.8%. So clearly different metrics here.
Absolutely, and going back to that dividend comment for a moment, if we look at payout ratios today versus back then, we are at significantly lower levels with higher amounts of cash on balance sheets of corporations. So from a valuation perspective, don't get too worried that we're topping out here at new all-time highs, because there's still very good value in the market. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Kris and I are going to talk a little bit about the earnings, because first quarter earnings is just kicking off right about now. So until then, I'm Grant.
And I'm Kris.
And we're the two investment guys.